Welcome to today's webinar, compiled and produced by the team at biznews.com. All of our webinars are interactive. We encourage you to pose questions to our guests. The more challenging, the better. And the earlier you get the questions in, the better the chance of having them answered. The recording of this webinar will be available later today on the biznews.com channel on YouTube. Yeah, there we are. Our guests today are, well, I guess it's me and Stuart here. If you would like to, let me just get myself looking a little more framed there. How's that? Stu?
You need a bit of headroom there, Alex. Sorry, we didn't do a pre-check this time. No.
Oh, it's going a little bit. It's going. We've got lots of people on the webinar today. Not surprisingly, this portfolio has done amazingly well, as you can see there. We have, however, fallen below 30% in compound annual growth in rand terms. That's unbelievable, really. If you consider that Warren Buffett's return over 50 odd years is about 20%. So the best investor in the world. Just shows you what an amazing run we've had. Compound annual growth rate for our US portfolio, there in US dollars, is just under 22%. In fact, that went up in the past year. We are, in the past month rather, we're down slightly in rand because the rand was up, would you believe, 5% in the past month. So anyway, we're going to be talking lots about that as we go forward. But first, Stu, do you want to make sure that we've got all the tech and everything else sorted out?
Excellent, thanks, Alec, and welcome all. Those new to the webinar, there's a little high five option on your control panel. If you can see Alec and myself and hear my voice, and there's a little presentation underneath, can you just give us a high five just to make sure that everything's coming through? There we go, Alec, got some nice high fives there. That's good. We do like to keep it conversational as well. There's a little question mark on that same control panel. Just open that up and pop your question, and then I'll pass on to Alec as we run through the presentation of how well the stocks have performed, Alec.
Yep. Okay. So all good. Everyone can hear us. Yeah, please do put your questions in. Yesterday, with our webinar on COVID-19, on the debate, we must have had 36 questions that we never got around to. So if you've got something, some burning issue that you'd like to engage on, please get it through as early as you can. Otherwise, I'm just trying to get this screen working here. There we go. That should be a bit better. Otherwise, we won't be able to get around to it. It has been, as you can see there, from the first slide. Let me just take myself off screen now. I think Stuart will also go off. There we go. The way this works is that we go through a presentation of the portfolio. I've got two stocks in particular that I'm going to be talking about towards the end of the presentation, and they are pretty self-evident. I'm not talking much about Naspers in this presentation because we've got the Chief Financial Officer, Basil Skodos of Naspers, in our studio on Monday. So we'll be talking all about the Naspers results on Monday in the Rational Radio webinar. Remember, that's for you, being a premium subscriber. This webinar and that webinar attendance is only for premium subscribers. So do make a note of trying to, if you've got Naspers shares, and who in South Africa hasn't, then you need to be with us on Monday. We're dedicating that to Naspers' recent financial results, which for us in the media industry was interesting to see 360 million rand loss at Media 24. And I know they're trumpeting how well they're doing at the moment. Wow, that's really quite a scary situation to be in. But South African media industry is taking quite a lot of strain. Fortunately, here at BizNews, we are agile enough to be, and we've got fantastic people supporting us here on our premium, etc., with our business partners. So we're actually doing quite nicely. We see the ability to trade profitably as being a reason for sustainability. Okay, so let's start talking about our portfolio. You might remember that October was an incredible month. In fact, the portfolio value, remember, it started at 2.3 million, got to an all-time record of 10.6 million rands and $651,000. In fact, in dollar terms, we did even better in November, very slightly, up 0.2%, but primarily through some very nice increases there by Cloudflare and Slack. This is the second month in a row that Cloudflare has had a huge increase. Previous month was up 40%. Now it's up another 20%. So I'm going to talk about Cloudflare a little bit later on. What is going on there? Should you be trading out of the stock? Of course not, because everything we buy here is forever. But the changes in the share prices over the past month are on the screen now. Our biggest stock by far, Amazon, went down a little. Adobe went down a little. And actually, if you stop for a minute and have a look at the rand decline in the portfolio, because the rand was down by about 5%, improved by about 5% in the past month, then what you should be doing is taking this opportunity to invest in Amazon, because you're getting at Amazon 8% cheaper than you had it last month. Adobe Systems also 8% cheaper than last month. Spotify and 2U, I'm going to talk about 2U a little bit later, because that's being our underperformer in the portfolio. Both of those as well are now offering a lot better value in rand terms. So if you're a rand investor, and most of us are, as we're talking now, you could consider this as an opportunity to take advantage of the stronger rand. And there it is. If you have a look at that, you can see in the last 2 months, it's a rampage for the rand, and it has improved from around 17 to the US dollar to where it is at the moment, under 15.5. Why? Who knows? On a day-to-day basis, on changing in currencies, there are experts around the world. I'm not among them. All I can say to you is that from a longer-term perspective, under 15 Rand 50 Rand to the US dollar, then it looks like a pretty good time to be investing money offshore. Of course, those of you who've been following the big saga, the big move on retirement funds might not have picked up. The news that came through today was that a week ago, retirement funds were allowed to put 100% into offshore investments. Today, they've suspended that decision. So if you've done it already, and Magnus Haystick and Magda Wezikcha were very vocal about this last week, and hopefully Biznews community members would have jumped on the bandwagon and swapped their RAs. Well, you can't do it now. You could have done it in the past week, but you can't do it anymore. But it shows that the rand has been very, very strong. So I suppose at this point in time, it looks like if you're going to invest offshore, well, you are probably going to be quite happy when you look back on it in the future. But as far as our portfolio is concerned, you can see the impact of the rand has been a decline in rand terms for our portfolio, which is primarily an offshore portfolio. There it is on your screen now. As you can see, the growth by the stocks in the portfolio over the period that we've been running it, which is now coming up for 6 years. On the 4th of December 2014, we started. So 6 years ago, Stu. Quite amazing, how things have changed in that time.
It's a good run as well, Alec, over 6 years, the return. It's
been astonishing, but I think when you look back on it, what is interesting now is that the rand itself hasn't really been that big a factor. Of course, it has gone from 11 Rand 27 to 15 Rand 50. But if you'd gone back 6 years with a Jacob Zuma pilfering and all the plundering, pilfering sounds a little bit small, but and you'd actually estimated the rand 5 years or 6 years hence, you would certainly not have thought that it would only have been at 15.5, which is where it is today. But of course, anything can happen to the exchange rate. Also, what happened in this portfolio is that we sometimes have to grit our teeth. And when the pandemic hit us in March 2020, we did that and bought stocks. And you can see that the portfolio is up 47% since the pandemic hit, where it was already at 6.8 million. In fact, what was quite interesting was that the portfolio was pretty solid even during the pandemic, despite big losses elsewhere. And then it went up really well in the aftermath of the pandemic, helped along by, we had a good investment in Sasol, it just went out of kilter, so we sold that. And as it happens, it was a good decision. And Discovery has gone up really nicely, as you can see there, from 67 Rand to 124 Rand. Naspers has been a little disappointing overall, if you think of it, because it's 38%, 36% in a year. That's not disappointing, of course that isn't. But relative to the other portfolio, and then the big winner there, right at the bottom of the screen, is Cloudflare, which we only bought in March at 24.37. It's now sitting at $66 a share. So that's been a wonderful contributor to the portfolio. It started there, as you can see, on the 5th of December 2014 at 11 Rand 27. The compound annual growth rate since then has been over 20%, which I guess for anybody anywhere in the world is a delightful return. But as you can see in the past month, the Rand has appreciated by almost 1 Rand against the US dollar. Cost you 1 Rand less. Now, if that's got anything to do with Joe Biden and Donald Trump and the economic theories and the return of socialism and all these big stories that people are telling us about, I really don't know. And I would just defer to Warren Buffett, who says that it's very, very difficult, if not impossible, to call the big pictures, but you should be looking at the underlying shares. And that's exactly what we're doing here. And there's the individual stock performances. Again, I say this often. If you had the good fortune, as we did, to buy into Amazon 6 years ago, then any portfolio is going to look amazing. And that's really been our biggest mover. Down at the bottom, Wilson Bailey, in fact, improved in the past month, went down into the early 80s. And then we had the confirmation of the infrastructure program in South Africa, and that's now gone back to pretty close to where we bought it. Slack has also moved into profit. We think that that's a stock to keep an eye on. And even better value today is 2U, which in Rand terms is down nearly 20%. It's been affected quite a lot by the South African Rand strength as well. But generally speaking, what happened with 2U, we bought it over 3 months. During that 3-month period, the share price went up very strongly. They had a $300 million share placement, which is great for the company, but it wasn't great for the share price, and it pushed the share price down. But the company is in pretty good shape, and I'll give you some more information on that as we go through. That's, as you can see, a graphical perspective. Look at Amazon, just way ahead. But what is interesting when you look down at the bottom there at the US dollar, pretty much everything has outperformed the Rand dollar. And when we started this portfolio, the idea was that the Rand was going to weaken, which it's done, and that if we could be careful in selecting shares and holding on to them for the long term, or as Warren Buffett tells us, your average holding period is forever, then whatever the shares outperform the Rand by, that would add to the performance of the portfolio. And as you can see there, we got very lucky. Microsoft, Apple, Adobe have done very well, but of course Amazon has pulled everything through. And here we've had Cloudflare in the past 6 months, which has been a great return as well. Okay, do you want to grab some questions before we go on to the rest of the presentation, Stu?
Thanks, Alec. You mentioned Biden. Need to ask for your thoughts, please. Going forward in the administration under Biden, we may have a weaker dollar favoring more risk appetite in emerging markets and hopefully giving the JSE a boost despite unknown issues. Basically just your thoughts on that sort of sentence, Alec.
Dieter, I'll go back to what Warren Buffett said when he was asked about Donald Trump. That would have been in 2017. At the Berkshire Hathaway AGM, and he said, America is a fantastic country. It will survive Trump, and it will come back stronger. And I guess if you asked him about Joe Biden, he'll probably tell you that America is a fantastic country and it'll survive Joe Biden. There's lots of media hype around lots of things. Right now, when I watch television, news programs, and not the news program so much, but the advertising around it, it actually irritates me enormously because it's almost like there is a scaremongering tactic against COVID-19. The Sure, you must wear your masks, because if you do happen to be infected and nobody knows you are, or you don't know yourself you're infected, you can infect other people. And of course, it's a good idea to wear masks to ensure that you don't infect others. But to have this absolute panic that has happened around the economy, driven hugely by the US media, and there's quite a lot of, in the US I'm talking about now, here in our country, we're not much better, but there's quite a lot of parochialism and maybe side taking in the US. Donald Trump was a crazy guy, but it doesn't mean that he doesn't deserve at least some kind of balanced coverage. And in this election, it's been one-way traffic supporting Biden. The concern that the rational mind would have is a lot of the policies that Joe Biden has been put forward, not so much him, but Kamala Harris is a little bit closer to Bernie Sanders, who's a bit closer to Jeremy Corbyn, and we kind of know what these people think. And if you read Business Day in the course of this week, you would have seen that the Chinese government took a half-page advert where they spoke about new socialism. So new socialism in China, by the way, means that if we were doing this webinar right now, we would have a censor standing next to us. In fact, we wouldn't be able to do the webinar because it is open information. So that's a very strange way that the rest of the world is looking at what socialism and communism does. But I guess the Cold War was a long time behind us and people's memories fade. Joe Biden is 77 years old. He's not the kind of guy who's going to go there and disrupt anything in the way that Donald Trump did. He's a career politician. He's been on the hill, in the swamp, as Trump would call it, for 50 years or something of that order. And you could probably expect that Biden will do a lot of what you expect him to do, which is going to be play politics. So the political normality will come back. One good thing, obvious good thing, is for the rest of the world, for us, is that America is not going to put America first or make America great again, as in the philosophies that Donald Trump was putting forward. It's going to be much more of a multilateral kind of approach, which is far more sensible on any scale. So that can't be a bad thing. But to start adjusting your share portfolio on the fact that there's a different political leader in a country where the checks and balances are so huge and so powerful and so well embedded. I mean, as Buffett says, America survived Trump. It's certainly going to survive Biden. And he didn't mean it in the sense that this is a threat to the system. He meant it in the sense that the system's got enough checks and balances. So I really wouldn't start working that into my whole thinking. The thinking that we've got to do is go in, what are the companies that we are investing in? We are co-owners of those businesses. Are they well-led? Are they efficient? Are they in the right market segment? Do they have something different? Are they an exponential business? Are they going into the future growing rather than many that are contracting? And those are much bigger questions than worrying which political leadership happens to be in which country.
Like I know we always say this too shall pass, no matter what it is.
Oh, of course it will, yeah. But good businesses are built forever. Yeah, built to last. And when you look through this list, Amazon, they're continuing to grow 20 to 30%. They're disrupting the market that they're in. Apple's the same thing. There's an ecosystem that you are buying into when you buy Apple. And it's an ecosystem that's got over 1 billion devices. They haven't even touched the surface yet on the services they can earn from it. Adobe is one of the great software businesses in the world. Adobe Audition we use all the time, but there are many parts to the Adobe setup, including the PDFs, which are in Adobe invention. Microsoft, you don't have to say too much about that. Microsoft Windows, it's everywhere. Naspers, from a South African point of view, that's a very cheap way into Tencent, which again is an exponential company, the Chinese equivalent of the American giants, excepting that it gives you a combination of them. There isn't the the antitrust issues in China that there are in the United States. So Tencent is like your Microsoft together with your Facebook and Instagram all rolled into one. Discovery, Netflix has got dominates its own market, continues to grow exponentially, still growing into the international community, chewing away at the media, taking advantage of media on demand versus the one-way traffic. You've got Discovery, which is a fantastic South African company, highly innovative. It's up 111% for us in 6 months. What more do you want? Wilson Bailey is the odd man out. That's a play on South Africa's infrastructure program. We've got to believe that Ramaphosa is going to get that one right. Spotify, dominant in its field as well, also moving very aggressively into podcasts, which is an exponential market. 2U, exponential growth company as well, hasn't been appreciated yet by the market by Mr. Market, in the sense they're the dominant, the leading company in online education for tertiary institutions. Slack, anybody who's used Slack, a communications vehicle, knows just how powerful it is. Their financial results coming out on the 9th of December. I think we're going to see some good numbers there because Slack has been moving up in the right direction. Again, an exponential company. And then Cloudflare, which I can tell you everything about a little bit later. So that's what it's about. And there's no mention there at all of Joe Biden and how he's going to impact anything.
Thanks, Alec. 2 questions on the tech stocks, contrasting from Dieter and Guy. The Guy says, are they in a bubble territory? And Dieter asks, with a little pullback, is it not time to buy?
You know, I did a piece this week on information that was disclosed by the International Financial Institute, or the International Institute of Financial Organizations. They're in 70 countries. They've got thousands of financial institutions who are their members. And they made the point that the world's debt grew by $6 billion in the 4 years to 2016. Okay, $6 billion. The world's debt has grown by $52 billion in the 4 years from 2016 to 2020. Now just think of that for a minute. Trillion, not a billion, my apologies. 6 trillion, 52 trillion. So just think to yourself, they have created these governments and central banks $52 trillion in 4 years, as against kind of a running average of 6, which was the previous 4 years. That money goes somewhere. Where does it go? It goes into the economy to lift the economy. When money goes into the economy, it reflates the place. We've got low interest rates because of the Chinese factor, but we can get into that in a different sense. But they're just throwing money throwing cash at the system, and that is keeping interest rates low. So where does that cash go to? There's no point in putting it in the bank and getting no interest. So you will find the assets that make sense to you. When you look at the property market, you got to be scared stiff, because the way that COVID is affecting property assets now is at the very least uncertain. So where do you go? You've got to go for companies or a slice of enterprises. And then when you ask which enterprises, those that are growing. So by a process of elimination, tech stocks are not in a bubble. These are not tech stocks, by the way. These are exponential companies. And why are they mostly technology based? Well, because the world is changing. So as you get new technology, it eats up the market shares of old tech companies. Think in our industry, newspapers versus online. I remember when I started MoneyWeb in 1997, people thought I was stone mad. What are you going to do? Leaving I had a good career going for myself, but going into online. What is this online thing? Well, at the time, I drank the Kool-Aid, and I believed the internet was going to change everything. And boy, did I get like the rest of the world, quite a wake-up call in 2000, because things don't happen as quickly as you think they're going to. But as Bill Gates very famously said at that stage, we underestimate the long-term impact of these revolutionary changes. And if you have a look at the stock market does not underestimate the long-term impact. It prices today and continues to move capital from those companies that are contracting, or those industries that are contracting, to those that are expanding. So when you buy into technology shares or NASDAQ listed companies, or what I prefer to look at as exponential companies, I mean, just think of this for a minute. We have gone in this portfolio in 6 years from 2.3 million rand to 10 million rand. That's incredible. If you'd said to me in 2014, here's 2.3 million rand, can you make it into 10 million rand in 6 years? I'd have told you, stone mad. It's not possible. And yet the return has only been 28% per annum. That's what happens. So that's an exponential growth story. When you have a look at these companies, they're growing at between 20 and 30% a year. That's the kind of company you need to invest in, an exponential company. If one of them falls over and stops growing by 20 to 30% a year, well, then you should be looking elsewhere. But at this stage, they all seem to be extremely set fair. And that's why it's hard for us to get our heads around exponentiality. We human beings, after all. Go back 6 years, 2.3 million to 10 million in 6 years. No, it just doesn't seem possible. But that's what exponentiality does.
Lovely, thanks, Alec. A question from Russell, I suppose, with all the vaccine talk, it makes sense. He talks about his pharma positions. He's got Merck, J&J, and Aspen.
Sure.
He says they're at weight. He's considering going overweight for the next 12 months, given all this anticipation of vaccines, etc. He says, is it not too naive a way of looking at the potential in this space?
No, I think what you've done is very rational. If there's one industry that is going to be supported by those who make the rules, and the ones who are making the rules are the government, it's got to be the pharma sector over the next year. So I don't know the pharma companies well enough, so I wouldn't have known where to put any bets or place any bets, but well done to you. I do like Aspen very, very much. In fact, we had Stephen Sard on the Rational Radio webinar a few weeks ago. And at the time I thought, wow, this is a stock. From what he told us, it just screamed at you that it was a very good investment at, I think at the time it was about 20% below where it is today. So if you bought in early, there would be no reason for you to want to take profits or to change anything. J&J, we haven't heard about their vaccine yet. We've certainly heard about the others, AstraZeneca, Pfizer, Moderna, and the share prices have reacted accordingly. Whatever you might think about the pandemic, and there are many, many who believe that it has been overblown and overhyped, it doesn't really matter what you believe. The reality is that the governments are going to be buying vaccines and we're all going to have to get vaccinated. They're already, I heard today from Miles van der Molen of SEME, he said that Qantas are now going to be forcing anybody who takes a flight, and I think Qantas are only reopening here in April for the South Africa-Aussie route, to have been vaccinated first. So, and they probably won't be the only one doing that. And if Qantas start, who's to say that you don't have to carry something on your phone like the Chinese did at one stage, or maybe still doing, to show that you're clear of COVID-19 because you've been vaccinated, or whatever the case might be. So I think you've got a very good strategy.
Thanks, Alec. Schwab just asks, I know you mentioned the JSE. He says, don't you think that investing into the JSE will be more lucrative than offshore, given the fact that it's so cheap?
It's only 0.5% of global investable assets. And I think that's your answer. You can't buy Cloudflare on the JSE. You can't buy 2U, Slack, Spotify, most of the stocks in this portfolio. And it's not that we're buying an index. You might be right. The JSE All Share Index, which has horribly underperformed for the last decade, may well outperform this year because it is so cheap. But on the other hand, if you're buying an index, you're not really paying attention to the reason why you should be investing in shares, which is to try and become a partner or a part owner in a company that you understand and that you want to be part of as it grows forward. The trouble with an index, and I know that we get hundreds of these arguments coming from the passive funds, and now the money is moving to ETFs and passive funds, and the trouble with that is that you get what the market does. Whereas if you're investing in individual shares, it gives you the ability to learn and to go for the ride with a management team and a company that you believe in. So if you were taking the JSE top 40 versus the S&P 500 index, well, what happens to the top 40 if Naspers hits a wobble along the road? That's a problem. You basically take a 25% punt on Naspers if you're going into the top 40 index anyway. So there are lots of little nuances that go with buying index and buying passive funds. For me, this is the way you should be doing. You should be investing. You should be finding companies that you can relate to, that you understand. An Apple, you have an Apple phone, you love the product, you use Apple equipment. You think to yourself, crumbs, this is a good company. Then you start reading about it, reading what they're doing, understanding where they're going. And as a consequence of that, you'll buy some Apple shares, maybe, because you think that it has got a wonderful future. So the JSE doesn't have an Apple, doesn't have an Amazon, doesn't have a Cloudflare, etc. And that's the problem. No, I wouldn't be putting all my money into the JSE.
Thanks, Zach. Dorian asks, with a 47% rise over 6 months, aren't you tempted to hedge some of those wins just in case there's a tech pullback?
Yeah, it's a very good point. I've looked at this over the years, and there have been many times, most times in the last 6 years, that you think, okay, why don't we do this? Why don't we sell half the portfolio, put the money on the side? Then we've got a guarantee. Then we can give our marketing splurb and say to people, wow, look at this portfolio, how well it's done. And we guaranteed to have a market beating performance for the next 10 years. That's not the way we operate, first of all. This portfolio is a model portfolio. The idea here is that we investigate and find exponential companies, because the trend to exponentiality is not just the next 5 years. It's a 100-year trend. It's a whole transition of the economy as it is. Unfortunately, it's been blown out of all proportion by well-intended academics who call it the fourth industrial revolution. A much better book, a much better description is the second machine age, which was written by Ben Johnson and I'll get his name in a minute. Andy, come to me in a moment. Anyway, that was the book that started the fourth industrial revolution. It was called the second machine age. Go and read that one if you want to get an understanding of how far we've still got to go. Internal combustion engines are only going to be phased out or gone in 2030. That's the time that electric cars are going to take over. Who's going to win the electric car battle? It looks like Elon Musk is, despite all of his issues, is going to be the winner in that, or certainly at this point in time, he's way ahead of the field. But there won't just be one Elon Musk. There'll be many, many more vehicles. If you just think about how big the motor sector is and how long it's going to take the motor sector to transform. This second machine age or industrial age is like the first industrial revolution. That didn't finish in 10, 20 years. That went on for decades. And that's a similar kind of a system that we're talking about now. So if you could go back 10 years or 25 years to China, what would you do? Where would you invest? It's quite clear, because there was a strong growth that we saw in China as it was growing relative to the rest of the world. And that's the way I look at these companies. That's the way I look at the long-term change in the economy. You either believe that the economy is changing, that technology and the internet really are changing everything, or you believe that this is a temporary blip. If you believe that it's changing, you buy the shares for the average holding period of forever. You try and find only those shares that are well capitalized, well managed, and focused on the right areas. And it helps if they've got a dominant position in their market already, because it's so much easier. Ask me, I've had 2 startups, to run a company that's already there rather than get one from nowhere, starting it up from nowhere. And as a consequence of that, a Cloudflare, for instance, is just so well positioned relative to the rest of them. So that's, if you're a trader, yeah, you'd probably take your profits. But if you're an investor and if you buy into companies to become participants in that company over the long term, then you wouldn't be selling any shares here. And I would just leave you with a thought from the greatest South African entrepreneur by a long way, although he doesn't really get credit for it, is Koos Becker from Naspers. You know, we hear the other names, but Becker is by a multiple wealthier than they are, and he's been far, far better at creating from nothing, or from debt that was leveraged from an old media company into this extraordinary business that has transformed, and it literally has, retirement savings in South Africa. Because Naspers' incredible run has been translated into its big stake in the JSE, which has given us a wonderful return. And how did he do it? His brilliance has been not to sell Tencent shares. He bought Tencent, 50% of Tencent for about $30 million. And over the years, there have been many calls from investors to Naspers: sell your Tencent, unbundle Tencent. You're trading at a big discount. Get rid of your Tencent shares. And he has resisted it until about a year ago, when they sold 2% of the shares and banked $10 billion, which has now secured Naspers for life. And of course, what they're doing with that $10 billion, they're taking 5 of it and they're buying back their own shares because of the huge discount, which is a very rational thing to do. But I think that puts it in perspective. Had Koos Becker sold the Tencent shares at any time that the very supposedly wise but actually short-term driven asset managers had been telling him to do that, well, today the whole of South Africa would be poorer.
Thanks, Alec. There's an issue from Kirsty. It's almost like, where would you start if you had to start this portfolio today? Because she says, I've transferred my first $1 million into my WebTrader account. What would you recommend buying? To what percentages, and should it be over 2-3 months? Would you just recommend going all in?
Thank you for that. That is a very good question. It's one that I often get asked through emails from people. I would really just look at these stocks in the portfolio. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Okay, so we've got 12. So if you divide it, you'd roughly get 8% into each one of them, if you did it that way. What we've done here, I don't know if Amazon is going to be the next 845% growth in the next 6 years, or if Spotify is going to be one doing that. What I can tell you, though, is that each of these stocks that are in the portfolio, for you to now replicate this portfolio and put 24% into Amazon, 18 into Apple, 18 Adobe, and so on, would actually be probably the wrong way to approach it, because you are starting from a zero base. The important thing about investing is to know what you're investing in and to stick with it indefinitely. Now, not all of these shares that are in the portfolio are going to be winners. The South African stocks, as you can see them, they were bought at a particular time, at a time that it appeared as though the rand was undervalued, at a time that the shares themselves, Discovery in particular, were very cheap, and at a time that when we brought the money back from overseas to take advantage of Naspers, which really is it's done 38% in a year in rand terms, 36% in US dollars terms. So it's done very, very well, but it was really so cheap. And so you combined apparently strong rand with a very weak relative share price of Naspers, and that was the right time to do it. But if you were to start it again, I would propose, and you've put all your money into WebTrader anyway, that you just take those stocks, those, 9 offshore stocks, and allocate them pretty much according to how you feel. But if I did it now, I would have a slight weighting towards Amazon and Apple, but the rest could be divided equally between them. So that's the way. Cloudflare has had a phenomenal run, but it is an incredible company. 2U is as you can see, that's been on the other end of the spectrum. That's gone the other way around. And I also like Slack as well. I think that that's probably the right way. So the way we started this portfolio, we had 2 bankers. You might remember those of you who were around at the time. And those bankers were Berkshire Hathaway and the S&P 500 index. And those were making up about 40% of the portfolio. And then we had 5 stocks that were 8%, so they were 20% each in those 2. And there were 5 stocks that were 8% each. And one of those 5 stocks was Amazon, which has gone from 8% of the portfolio when we started to 24% now. So it shows you how much it's overperformed. Apple, similarly, we had that at 8% and it's now 18%. And we've made a few changes as we've gone along from there. But that was also quite a nice way of starting it, was to say to yourself, which are my bankers? Which are the ones that I'm so confident about those companies? And you could almost, for me, you could say Amazon and Apple would be those 2 bankers. So I'd be comfortable in putting a bit more into those. It could be 15%, it could be 20% if you're feeling that strongly about them. And then the rest, divide them equally, because you don't know where your next Amazon is going to come from.
Lovely, thanks, Alec. Owen just wants your comments on, he says the action taken by the Chinese government to stop the ant listing and the comments made, does it not influence the Tencent holding?
Yeah, it does. And that's what you're doing with China. As I mentioned earlier, people, the Chinese government taking out that half-page ad in Business Day and talking about the new socialism. Well, that's also the new socialism. If you happen to get too big for your boots, we'll just abort the biggest IPO in history with no thought whatsoever to the consequences of that, because A, we can, and because B, we'll show you who's the boss. And I think that you've put your finger on something that is very, very relevant. We forget too easily that China is an autocracy, and there's one man there who's got enormous power. And President Xi might be, in some people's opinion, doing a good job. In many people's opinion, he's not. And those people who are being oppressed in China, and those who are perhaps of the wrong grouping, or you happen to be in Tibet, for instance, there's many, many examples. If you're in the media industry, you forget being in China, because there's no such thing as a Chinese media company that is independent. You just can't be, even if you're in Hong Kong, because you do have the state. It's a little bit like, we remember the Soviet Union, we remember Pravda, and because it was close to our time zone and it was well covered in this country. But China is so far away. So your point that you're making there about Tencent being at risk, of course it's at risk. It's a total risk. So you've got to be careful about where you buy Naspers. You wouldn't be happy to buy Naspers when Tencent is overvalued, but Naspers is sitting at a 50% discount to its underlying value in Tencent. So even if the Chinese government goes ape and does something stupid, which is really, really hurts the Tencent business, which, by the way, is not what they want to do, because they want to build national champions. That's one thing that autocrats like to be able to show you their pieces on the chessboard, especially if they can manage them, as we now know that Jack Ma is being managed pretty closely, and Alibaba, and of course the ant listing, by the Chinese bureaucrats. Who knows what the future holds, but what it does do is it brings an added risk to an investment in any Chinese share, including Naspers. But Naspers sitting at 50% discount. You might remember I had some concerns about Naspers 3 months ago, but then after reflecting on it and looking at the discount that the stock was trading at, you really have got a big enough margin of safety to ride that out.
So hasn't that discount just widened, Alec?
It keeps widening, and they keep throwing money at it.
Yeah.
You know, the $5 billion that they're putting in now is helping. It's certainly contracting the discount, and they're going to do everything they can to reduce that discount. So it's going to be good to talk to Basil Skordos next on Monday.
I know you were going to lead into Cloudflare and to you, Alec. Jeremy might be good on. She says, using Cloudflare as an example, is the expectation they will continue to outperform? Sorry. What about the risk of competitive companies, other disruptive technologies?
Thank you. Now, you've been so kind because you've given me the opportunity to go through this a little bit. And I'll go through it rapidly. I'll take no more than 5 minutes. There's the Cloudflare share price. As you can see, it's done incredibly well in the last little while. It's moved up from, last month it was up 40%. So it was around 35 Rand, $35. Got to $40, then it went up to 60. Reason for that, they brought out a new product which wowed the market. And of course, buy on rumor, sell on fact. That's what happened there. It came back to almost $50. Then the financial results came out, the quarterly results came out, and Cloudflare took another big run. Why? There's the business model, and I think you can just stop for a minute and just understand that first point and the second point there is what really matters, is a large and growing addressable market. They are disrupting a huge part of the tech market, and they are widely distributed. So many people bought Amazon, Microsoft, even IBM to a degree because of their cloud technology. Amazon is the dominant player there. Amazon Web Services, by far the biggest in the cloud. They went 7 years ahead of everybody else on cloud. But now today you look at cloud and you say, okay, that's the way it is. We don't buy these computers anymore with huge hard drives because we can just put everything onto the cloud, particularly if you're a company. So the cloud is where it's at. And this is a company that it was built for the cloud. So its whole model, I love this, and I know this is this comes from their latest quarterly numbers, their quarterly presentation. If you just have a look at this without going into the detail, there are 3 things that you can focus on the transformation of the old tech to the new tech. The old tech, you used to buy the stuff. As you can see there, it says hardware, software, buy. Yesterday, today, you just rent it. And in those 3 areas, storing and computing, starting at the bottom, you can see the cloud players: Google Cloud, Amazon Web Services, Microsoft Azure, and Alibaba Cloud. Right. On the left-hand side, you used to have hard drives: Compaq, Dell, Lenovo, HP, Sun, etc. Okay, so that kind of understands. Now look at where Cloudflare is operating. It is the only player there in a market that previously used to be shared between a whole bunch of them. And it's had that first mover advantage and way ahead of the competitors. A little bit like what Amazon did with cloud, where it's now, I think, 3 or 4 times at least bigger than the next biggest player. And the next biggest player has been throwing lots of money at it. So this is where Cloudflare is. When you want to network your computers, it's the old way of doing it was wires, etc. Now it's through the cloud. So just think of it that way. It is a whole new avenue, and one that has got quite exciting. And the applications, by the way, look at that. SAP, Microsoft, and Oracle had it all to themselves, and now we use things like Zendesk and Adobe and Dropbox here within Biznews. And I'm sure there's you would recognize some of the other names that are there. You don't go along and buy an SAP system anymore. There's many alternatives, cheaper and more efficient. And then just to show you a little bit about this company, that's where its locations are around the world. So it's globally networked. Now imagine trying to disrupt them when they've got all of this in place, more than 200 cities, over 100 countries. I like that figure there. 99% of the internet-connected developed world population is located within 100 milliseconds of the Cloudflare network. Amazing. It's extraordinary business. So what about the business itself? There's the metrics. It's only been around for 10 years. Compound annual growth rate of 50%. You see what's happened to the value of our portfolio at a 28% compound annual growth rate. So now put it to 50, and it kind of gets, you get to understand what's happening with this business. And there's a 68% compound annual growth rate in large customers. And there's the long-term model, which I like this most of all, because you see at the bottom, the operating margin. Any business of this kind that is investing heavily in the future is going to lose money. Operating margin minus 30%, 2018, minus 25%. They've just come now at minus 4%, and their model is 20% operating margin. Now, when you're growing at 50% a year, and you're going to have an operating margin of 20% plus on it, their gross margin at the top. So in other words, for the money that they get in, they only give off 25% of that, is the stuff of dreams. And they dominate the market, and they're cheap. They're not expensive relative to what else is available. So it's a phenomenal model. And what you got to ask yourself, can they keep doing it? Like, are they able to get to profitability? And look at that cash balance. They got $1 billion in cash, and they giving away or losing at the moment. Well, they're actually getting net cash flow at the moment. So they've turned that curve, hence the incredible growth in the share price recently. And this is the kind of stock you need to wake up to early on. We did. We woke up to it in March, and you can see the consequence. The rest of the market is, or not the rest of the market, the big money is now saying, okay, we kind of get it. We believe that that the story is right. So would you be selling Cloudflare now? No, definitely not. You've bought a slice of the company. We don't know where it's going to. On traditional metrics, it looks massively overvalued. But just take it. If you want to understand exponentiality, take an Excel spreadsheet and just put 20% growth, compound annual growth, for the next 10 years, and you'll be amazed at where the numbers actually end up on. We've got to get our heads around exponentiality to become successful investors today.
Thanks, Alec. Just from Willem, he asked, would you prefer, I know we've had this before, Prosus above Naspers?
No, Naspers is a better bet for us as South Africans, because we can buy it in rands and it's got a bigger discount. Really that simple.
Perfect. I know you mentioned ETFs. BJ just wants to know, does it not make sense to invest in the NASDAQ 100 ETF as opposed to directly into US tech stocks?
Yeah, it does. If you are the kind of investor who's not passionate about the individual stocks, who doesn't want to buy a slice of a company and wants to invest in technology going forward, yeah, that's fine. There's nothing wrong with buying ETFs. What I would encourage you to do, though, because it's really so much more fun, is to invest directly into companies and get to learn about that company, because that helps you in your own business life, in your own business career. When you're following a company and you see the decisions that they're making, you can see when they make mistakes and when they do things right and absorb it. You know, the difference between a wise man and a fool is that a wise man learns from others. And this is one of the best ways that you can learn from others, whereas a fool has to do everything themselves before they learn. And that's really why I would suggest, if you can, if you've got the time, if you've got the interest and the inclination, just buy one or two of these stocks and start reading the quarterly reports, and come on to the webinar every month, and you'll be able to see how those particular stocks are developing, or those companies are developing, and it's got to help you in other areas of life too.
Thanks, Alec. Albert just wants to know, have any of the shares in this portfolio yielded any dividends? And if so, how have you accounted for them in the growth numbers?
Yes, they have. We have got a dividend stream that's come through, and it goes into the cash. The dividend payers here are Apple, which is a significant dividend payer. I think Discovery, since we bought it, hasn't been able to declare a dividend yet. Naspers similarly. It's very small dividend from those two relative to the companies. But we do get dividends from time to time, and they get added to the portfolio, yes.
Thanks, Alec. Anthony just wants to know, the two stocks that aren't in the portfolio, Facebook and GM. What are your thoughts?
Facebook, We bailed in some years ago, Cambridge Analytica. It worried me a lot at the time. I'm still not a Facebook fan as an investor. And the reason for that is that Facebook is in an area where between it and Google, they have got approaching 70% of the advertising revenue in the Western world, total online advertising revenue. Now that is an antitrust suit waiting to happen. If that was the case in China, who cares? But in the United States, it wouldn't happen under Donald Trump because he is not the Republicans do not go for antitrust. Whereas under Biden, if you read, if the Democrats get control of the Senate, and it's not impossible, it's unlikely, but it's not impossible because there's still 2 runoff elections now in Georgia. If you read the, excuse me, I'm picking up your lurgy that you've got here. There must be something to do with the aircon. If you read through the report that was compiled by the Tech Investigative Committee, which we did publish the link to on the Rational Perspective newsletter a few weeks ago, you will see that, and the report was about 550 pages, you will see that there's lots of antagonism towards big tech. Now, if they go for Google and Facebook, in particular on online advertising, it will be a very popular attack, given that every other media company is hurting as a consequence of Google and Facebook. So if you're a politician, it's a good bet, it's a good play to have. I don't like Facebook on that basis. I think that they've also done really naughty stuff with the way that they've used the data that we allow them to have. People are getting smarter, getting to understand better. And as a consequence of that, the advantages that Facebook used to have in the past of huge power without responsibility are now falling away. So there's a few things on Facebook that bother me, but for the moment, they're making lots of profits. And I guess, that's what makes a market. There are lots of people who think Facebook's a good company.
Lovely, thanks, Alec. I know they mentioned GM, but I think to finish off, there's a question on Tesla, your thoughts, and obviously on the S&P 500 now.
It's so interesting, that one, because if you have a look at Tesla versus General Motors is your turnaround bet. It's your bet on a company that's going to spend an enormous amount of money, which they've already told us, on electric vehicles. They're going to throw money at it, and they're going to get to become the market leader in electric vehicles. They're already producing lots and lots of internal combustion vehicles. There's a school of thought that would say, go with Tesla because go with General Motors because it's cheap. The problem is when you have a culture in an organization that is based in the old industrial age, it is the most difficult thing to transform that culture. And history is full of examples of how businesses, even a business like Apple, when they were producing the Macintosh, because it was so different from the 2Es and the other computers that Apple were doing, Steve Jobs had to take his Macintosh team and stick them away in a part of the business and tell them to have pirate flags and not let anybody else go anywhere close to them because they were different. They were pirates. They were misfits. They were the oddballs. They were the people in that organization who were going to give them the future. Now, in a big corporate like a General Motors, there aren't too many pirates around. And if you have a look at Tesla and Elon Musk, well, he's the personification of a pirate, of a disruptor. We sold Tesla shares in this portfolio, and it's good because it keeps your feet on the ground. It was a mistake, but of course it was a mistake. We sold it at a lot lower than the share price is today. It's gone up 800% from where it was. And the reason we sold it was because we listened to the popular press and we listened to all the stories coming out of the United States that Elon had lost it and he didn't know what he was doing, and he was fighting with the SEC, and he was stubbing his nose at or flipping his finger to the investment community. That's what you want from a pirate. That's what you want from a misfit, from an oddball, from the person who's going to change the world. And I've been looking at Tesla lately and thinking, goodness me, should we be buying back at around $500 a share? If you just follow what Elon, and it's not just Elon, he's got a personality like that attracts incredible people around him. But if you just look at what they've done with SpaceX, the first private company in history to put NASA astronauts into the International Space Station. And more than that, when the SpaceX rockets go up there, they bring them back to Earth and they actually land them from where they shot them out. Not the old days or the big state-owned organizations that throw them into the sea. He's a phenomenon. He's incredible, and his culture at Tesla is one that tells you if you back human beings and people, and that's what investing is all about. Investing is not about buying inanimate objects. It's about buying special people or buying into special people, partnering with them, working with them into the future. If you go with that, then you have a look at Tesla being worth more than GM today, but in 10 years' time, it's probably going to be worth a lot more than GM at that point in time. But again, who knows? That's just a personal philosophy, and differences of opinions make a market. All that we're trying to do here is to stimulate your ideas, stimulate your thought processes. Go and look at these companies in the model portfolio, read through them, do your homework, start learning a little bit more about what these exceptional businesses, or so that certainly they look like exceptional businesses at the moment, are busy doing. And perhaps you can absorb some of those lessons that they're learning and make some money at the same time. That's kind of investing actually is all about. It's not about giving your money to somebody so that they can take 3 or 4 or 5% of it, and then you complain 10 years or 20 years later that your money is worth less than what you put in. Investing is about participating in the growth, or taking your money and giving it to somebody so that you can participate in the growth that you believe that exceptional human talent can unlock through the unlocking of their own human potential. That's what investing is about. And if you kind of get that, then you'll have a lot of fun with us.
Thanks, Alec. A lovely way to end. Very motivational on the investing side. But just on the video recording, we'll get that onto the Biz TV channel on YouTube. I'll put that link onto the chat bar, Alec. So hopefully in the next hour or two, if you need a repeat, be there.
And apologies also that we didn't manage to get around to all the questions, but I hope that I didn't talk for too long. But anyway, it's been great being able to share with you the portfolio this month. We're going to get 2U's results coming out on Slack's results coming out on the 9th of December. 2U's results were out. I like them a lot. They continue to do well. I just quickly want to show you that slide. So when you're looking at the video, you can pick this up. They're sitting on lots of cash. They're doing the turnaround. Revenues are growing. There we go, 32 to 34%. Continue to do that. This is another exponential company, unrecognized. It's down 18%. I'm not worried. In fact, I see it as being offered 2 hamburgers. What's it, Wacky Wednesday at Steers? Yeah, it's something like that. Until the next time, cheers. Thank you for joining us for this webinar, which is compiled and produced by the team at biznews.com. A recording of this webinar will be available later today on the biznews.com channel on YouTube. From our team, until the next time, cheerio.